At Lazard, the focus of multi-asset really is to deliver risk-calibrated solutions to help navigate through uncertain markets, utilizing a very transparent process and a probabilistic forecasting methodology.
The probabilistic nature of the forecast is important. I think that we as professional investors have to be dispassionate when we're looking at the capital markets and not get sucked into feelings or our own personal beliefs. Our job is to interpret facts and assign probabilities to potential outcomes. The second stage is something where it's a separate discipline within the asset allocation process where we examine the sensitivities of different asset classes to some of those potential outcomes. And the third component is really the risk calibration, which is critical. You can take a probabilistic view and you can implement it right, but I think one of the often overlooked steps is the ability to take that view and reflect it in a risk space that is appropriate for the investor's actual risk appetite.
Delivering the best returns relative to risk really involves understanding a client's risk tolerance, number one, and then deciding what asset classes and what sort of investments would be eligible within those risk parameters. And then we're tactically allocating among those asset classes within those risk parameters. So it's really trying to deliver the best possible return within those risk constraints.
So the benefits of a diversified and balanced portfolio, I think, are well documented. I would see multi-asset solutions as a further evolution of this. And the way to use it, I would suggest, is either as a low beta core ballast for a portfolio around which you would put higher beta, higher conviction ideas that you might have. What you might want to do is solve for a particular outcome. Let's say you were looking to de-risk a portfolio overall. You would put in a multi-asset solution which has a lower volatility profile and a lower beta profile than perhaps your other market exposures. Ultimately, what we're trying to solve for here is delivering a specific outcome in a reliable manner.
Partnership with the quant team has let us add specific factor sleeves into the portfolios. It lets us take something that is maybe not a traditional factor, like growth or value, and move beyond those into something like pricing power, which is a factor sleeve that we use in our real assets approach.
Adding factor sleeves to a multi-asset portfolio is quite important because when you're combining different strategies, different asset classes, and different fundamentally managed portfolios, you can have unintended consequences in the portfolio. In terms of exposures, the quant team is able to basically lean against these factor exposures or to provide us with factor exposures that we may want based upon our macroeconomic forecast.
I think with portfolio construction, evolving the approach is critical. A structure that you build to fit one particular environment is not going to last forever.
The opportunity that we have right now is to harness the enormous amount of data, both in order to hone our forecasting capabilities and also for portfolio construction and optimization of asset classes within a given solution for what we're trying to achieve.
So I think the keys to generating alpha in a multi-asset portfolio are really taking a probabilistic approach to our macroeconomic forecast and tying that forecast into our asset allocation and tactically adjusting a portfolio for the macroeconomic environment.